That's a load of science.
Hello, everyone. Welcome to another episode of That's a Lot of Science, the podcast for scientific minds and everyone that loves about science. Today, we are going to talk about a slightly different topic than the one we talked until now, because it's not definitely scientific, but it's going to be important and interesting for all of you that might have a scientific mind and a great scientific idea. I want to turn that into a business and want to turn that into a company. And to talk about this today, we have Terence Smith, portfolio CFO, and also an angel investor himself, and a real expert of funding round and supporting company into getting funding to convert their ideas into business. So first of all, Terence, thank you very much for being here with us today, for accepting the invitation. And as I always like to start, I leave the stage to you for introducing yourself, talk a little bit about yourself, your background, and please go.
Sure, thank you, Alessio. Terence Smith. So, as Alessio said, I'm a portfolio CFO. I'm based in the UK. I did an economics degree after I finished school, and then I moved into accounting. I never wanted to be a accountant, but I went down the Times Top 100 companies to work for in the careers office, and Rolls-Royce, who are a FTSE 100 company in the UK, gave me an interview and I got the job. So I worked at Rolls-Royce for 8 years. They make aerospace engines, nuclear submarine propulsion systems, and various other things. Then I moved to JCB, who are a big construction equipment manufacturer in the UK, and then to a manufacturer of transformers and switchgear, so electrical infrastructure. So they supply national grids around the world. So the first sort of 2/3 of my career was in manufacturing and finance in large organizations. Then when COVID struck, I decided to start my portfolio career. So a portfolio CFO or finance director typically works for a number of different companies. And if you think about the price point of that sort of service, a senior finance person in a organization, the kind of organization that requires a portfolio CFO, so somebody that works 1 day a week or 1 day a month, tends to be companies that are smaller and either going through some change, so a kind of a technical change or a change in strategy, and they can't afford a full-time CFO, or they're startups. So for the last sort of 5 years, I've worked in the startup world. That's typically been with companies that are looking for funding. And along doing that, I've moved from manufacturing into tech, not just med tech, but all sorts of tech companies, typically SaaS businesses, so businesses that sell software as a service. And because I've been in that world for a few years now, I've also started angel investing. So I invest in companies, very pre-revenue companies. And my wife and I run a consultancy, TNX Consulting, that helps companies, specifically in the UK, get funding, whether it's angel funding or venture capital funding or private equity. Typically, we're at either end of that, so angel funding or private equity, not so much VC. But I know we're going to talk about what that actually means in a few minutes.
Yeah, exactly.
But I live in the UK with my, I work primarily remotely with my family. I've got a 3-year-old and a 1-year-old, and I love what I do. I work probably 12 hours a day, including weekends, but I never think of it as work. It's a hobby. I love doing it. I love helping companies grow.
Great. Okay, great. Amazing. Yeah, great. Thank you for your introduction. And yeah, I mean, you already covered all the points that we are going to talk about it later, like all the differences and all the approaches and the strategy that are usually associated with the startup world when you have to get the money, get the funding in this world. I mean, you already mentioned that you already did this shift in a sector that was more like automotive, construction, electricity, and then now you are into tech and medtech. And speaking of this, like, why is the medtech sector important for you, or like why you feel attracted to it, or what makes it unique compared to other industries.
Yeah, I think you struck the nail on the head when you said unique there. It is particularly in the UK, a unique industry. What you have in the UK is a legacy organisation in the NHS, in the National Health Service, that is very difficult to work with or for innovative startup companies. And so there's a unique challenge. So there's a very unique way of doing business with the NHS, which I think is similar in the US, for example, where you've got big pharma companies and you've got almost a gulf between the biggest healthcare providers, insurance companies, and so on, and then startup companies. So there's a bigger leap in healthcare from an idea stage company to a national rollout of a product or a service than there is in manufacturing. In manufacturing, you might be improving something that already exists, or there's multiple suppliers. We talked about the automotive industry a second ago. There's lots of suppliers. In the UK, there's one supplier of free healthcare, the NHS, and albeit there's private healthcare, it's kind of a unique industry. I think that's one element. The other is that there's a patient outcome at the end, so it's very easy to relate what you're doing to something that you actually see a benefit of in real life. Everyone can, I work in, well, one of my clients rather is a diagnostic company. When my daughter was born, she was quite ill, had to have blood tests straight away. And I stood there thinking, I wish these blood tests were quicker. I wish the results came back immediately. And I work for a company that enables that. When I worked at JCB making construction equipment, of course I saw a digger drive past on the road, and I understood what the product did, but I never was a benefit. A recipient of the benefit. I think in healthcare, it's really easy to relate the benefit of what you're trying to achieve to the actual work you do, regardless of your profession. Obviously, I'm an accountant by trade, so I'm typing numbers on a spreadsheet most of the day. But actually working for a company where where your family can benefit, or you can see a real life benefit, and you can see something that actually makes a difference to people's lives. That's the other unique element. So the industry structure and the fact that you see the outcome.
That's also a great point that you raised there, because it's also one of those driving force for like scientists like myself or like a lot of colleagues. So the fact that you could see an impact working in the healthcare sector, or like in this specific in the med tech, you can have also an impact on the people and on the outcome, and this is what drives us, the mission that drives us. No.
Yeah, and I think Alessio, when we talk about startup companies as well and founders, and I know we're going to talk about funding, the difference between healthcare founders and say manufacturing founders is really stark, because a healthcare founder typically is starting a company because either they've worked in healthcare and they see a specific need, or because they've been personally affected by something. Whereas in manufacturing, you never get that personally affected by something route. It's somebody who's come up with an innovative idea.
Sorry, do you feel that this makes more like involved the founder that works in that, or it's just a matter of being I don't know, a different profile of a founder?
I think it's twofold. There's positives and negatives from having that passionate founder who's really involved in the product. So the positive, from my point of view, trying to aid someone get funding, someone who's passionate, who can talk about the product for hours and hours and hours, they're very what I call presentable. You can put them in front of somebody asking for investment, and the passion will shine through, and they'll make convincing arguments because of that passion, and they're able to build rapport with people that potentially would invest, and they're able to find, or when they find investors that share the passion, there's an instant connection. So that's on the positive side. On the negative side, sometimes they're blinded by their passion. They don't consider the financials enough. They don't really have a business case for what they're trying to achieve. They know they've got a great idea, and they know they've got something that will, improve patient outcomes, but they don't know how to commercialize it or monetize it. And from an investor's point of view, that's what they're investing in. They're investing in making more money for themselves. So there's positives and negatives in having a presentable founder, a passionate founder rather. I think when you have a founder that isn't very presentable, then that becomes a different challenge, and that can happen in any industry. have a very scientific founder who might be slightly introverted, who isn't a good public speaker and isn't good at pitching. But you can have that in any industry. It's not healthcare specific.
And from an investor like perspective, what are like trends in medtech that you feel like you have to be paying attention to? I mean, you already talk about like these like how the founder come across, no, as presentable or less presentable. Do you feel like also there is a trend in getting these more often? I mean, people are more aware about this, or there are still like other things to consider?
Sorry, just explain the question again.
So when you talk about this, like you mentioned about this founder that have more, I mean, more or less like skills that being able to present what they're doing or not. Do you feel like there is a trend in getting better from the scientific person, or there is still, you know, this dichotomy between people?
I see what you mean. I think the in terms of personal skills and presentability within the scientific community, I think that is probably improving. But conversely, the technology is becoming more complicated, obviously, because, you know, last decade's problems have now been solved and now we're on to these decades' problems. And these problems are, you know, inherently more complicated. And therefore, you know, when you're trying to explain an idea to somebody, an investor who might not have any knowledge of the specific topic that you're talking about, I think any sort of improvement or change, rather, because it's not an improvement, you know, it's a personality type, you know, any kind of change in the presentability of a scientific what the technical term is, a technical founder. Any improvement in the presentability of a technical founder has almost been negated by the fact that new innovations are 10 times more complicated than they were 5 years ago or 10 years ago. You know, if you have an AI opportunity, explaining what that actually means to somebody today is very, very complicated. You didn't have that problem 5 years ago, and might be explaining a much simpler solution to a problem. If that makes sense.
That's a valid point. Yeah, speaking about AI, yeah, you're right. No, I mean, also there is a sort of a different approach towards AI. I don't know, from the investor perspective, like when this came across like 5 years ago, everyone wants it to be AI, and it looks like so important and so breakthrough. Now, I would think there is still like a lot of value in there, but maybe, I don't know, also investors get used to it.
Yeah, so I think it's gone beyond that. I think, you know, and I can talk about this from the point of view of being an angel investor and, you know, trying to get investment. As an angel investor, if there's an opportunity that has any reference to AI, I will almost, you know, 9 times out of 10 put it on a pile of, this is just somebody trying to take advantage of you know, what's a popular trend at the moment. You know, anybody can create a website with a product, and instead of .com put .ai at the end. And that doesn't make it an AI product. It doesn't make it an AI tool. There's a proliferation of, and I know because I've done one, of sort of chat GPT marketing layers over the top of what are actually very basic ideas. And those trying to pitch for business are people just trying to make a quick buck. They're doing something very simple that, you know, and you know, fair play to them. They're doing something very simple using you know, a publicly available language model, and it's not real AI. And just for an investor's point of view, distinguishing between significant AI opportunities and people that are just using a marketing layer, or a language model to do something that already exists but slightly faster or slightly better, that's quite challenging. So the good opportunities do get tarred with the brush of you know, the slightly worse opportunities. And as we were talking before this about the Rewired show that I went to, that was hundreds, I'm going to say, of genuinely good med tech AI companies trying to sell into the NHS, and there are huge opportunities out there for the right technology. And if some of them don't succeed, it's probably because of the way that they've presented themselves rather than the technology that sits behind the product, and because of that trend of investors being much more skeptical now of investment opportunities that call themselves AI that aren't genuinely innovative.
Yeah, that's a good point. I mean, also investors are getting those skills, right? Now they can distinguish between what is real AI or real innovation with other things. But you came, I mean, you put out a very good point here about the ability to communicate the validity of your idea. And you went to this conference, which, as you said, was very, very interesting and very innovative in their aspects. But from a scientific perspective, I feel like we were not prepared for these kind of things. So when we, I mean, I refer we as scientists worked in the lab, yeah, we are able to communicate scientific results to a scientific community, but outside of it, it's very hard to come across as knowledgeable as well. So then it becomes important also to learn those skills that make sure that your innovation is understood by those people that at the end needs to invest in you and believe in you.
Yeah, and I think there's
I was
going to say there's two ways of doing that, or three ways rather. So obviously you can explain your complicated scientific idea, and I'm a non-technical person, as you know, so I need things dumbed down for me. You can dumb it down to the level, sorry, I was going to say the intellectual level, the scientific level and scientific understanding of the person that you're presenting to. But most people can do that. But there'll still be an element of skepticism. And therefore, there's two further things that will prove to an investor that a scientific idea is credible, regardless of whether they understand the technology or not. So first of all, sales traction, and second, peer validity. So as an investor, whether you're an angel investor or a VC or a PE company, so private equity company, if your peers have invested in the product, then there's some validation there. There's peer validation, and when you do a funding round, the really tricky thing is getting your first investor. Once you've got one investor, the second investor is much more likely to invest because they know someone else investing. It's not just spreading risk, it's because they know that somebody else has done an element of due diligence on the product or the service that might be beyond their technical capability. So peer validity is massive, and then sales traction, because at the end of the day, what you're trying to what an investor is trying to do is they're trying to get a return on investment. And if people are buying your product, arguably it doesn't matter how good the technology is. It could be awful technology. It could be, the worst pen in the world. But if people are buying it, that's all the investor needs to know. So as long as you've got sales, either peer validity or sales traction, then they compensate hugely for, the lack of scientific knowledge of the investor.
Okay, yeah, that's a good point. And you already mentioned the different type of investor that you can find, like angel investor,
Yes.
VCP. Do you mind explain a little bit the differences of those
absolutely.
and how they enter at different stages in a startup funding?
Yeah, absolutely. It's something that frustrates me actually, because there's no rule and there's no law and there's no legal element to this. It's just a trend. And some people, to the point where some people think one type of investor can't invest in a specific type of company, which is never the case. So typically, I'll use the term typically, this is the way it works. So as a founder, you might have an idea. And in order to get your idea off the ground, let's pick a non-scientific one. Say a clothes shop. So you've got a new type of clothing. You want to design your clothing. Typically, you'll go through the first round, which is a friends and family round. So you'll go to your friends and your family and you'll say, "Can you lend me some money?" And they'll say yes. Hopefully, if they like your idea and they like you. Or you'll fund it yourself and you'll start your idea. So maybe you'll develop your new jacket, your new coat. Okay. Then you'll get to a point where it's developed. Typically you'll have an MVP, you'll have something that you can show people. So a minimal viable product. You'll have you've taken the idea, and it's become either a physical product or a service, and you're ready to sell it to people. At that point, typically, you've got another challenge in that selling to people is expensive. Either you have to, in the case of a closed shop, you need to have a premises, you need to have somewhere you can sell it, or you need to do some marketing, and that's going to involve another lot of cost. But you're also what we call in the industry pre-revenue. So you haven't sold anything yet. So at that stage, you're a pre-seed company. So and pre-revenue. So you're looking for pre-seed funding. So you're looking for someone to look at your concept and your prototype and go, I believe in that enough to give you some money. Now that will typically be angel investors. So that will be people, and professionals who have some savings, who want to make more money than just putting their money in a bank and getting an interest rate. And if you think about those types of individuals, they're making a choice, not just between investments, but between other things they could spend their money on. So it will be somebody who could buy a new car, somebody who could put their money in the bank, somebody who could take their family on lots of holidays, or they could invest in your company. And the only reason they will invest in your company is because they really believe it's going to grow. And they can see a point in their life in 5 or 10 years where you're successful as a clothes company, and they're going to extract some money, and that money is going to pay for 10 cars or a yacht, or some luxury thing in their life. So angel investors really are looking at generating wealth for themselves and for their family, but typically they're not very experienced. So they're not experienced investors. They're seeing an opportunity and they're taking it. It would be like me saying, Alessio, I'm going to make these gilets. I'm going to sell 10,000 of them, and you'll triple your money in a year. You might take that opportunity, or you might not believe me. But those people tend to be invested in quite risky investments. So if you think about the stage of a company, the earlier stage you are, the riskier you are. So that's that sort of angel stage. Then you move on to venture capitalists, so or VC. So once you've started to get some sales traction, and this comes back to my point earlier about people believing that you'll be successful or believing in your product or service. Once you start getting sales traction, bigger investors will be, and professional investors might be interested. So venture capitalists are people much like angels who they get they create a fund of money, and they do that by being good at returning for investors. So a venture capital fund will say, Alessio, Terence, if you give us 20,000 euros each, we will invest that 40,000 euros on your behalf in a quite high risk enterprise. So those venture capitalists, they raise between 10 and hundreds of millions of pounds or euros. And those companies will invest in startup companies that are about to sell something. So kind of a seed stage. Typically, they'll either need money to do some expensive work to finish their product. So they'll have a prototype but not know how to manufacture it effectively. Or in the case of healthcare, there might be some research and development that needs to be done that can't be done on just a friends and family amount of money. You need a laboratory, or you need to do a huge patient test or something like that. But it requires a significant amount of money. That's typically from 200,000 euros up to maybe 2 million euros. And that's at the launch stage of a product. Then once you've successfully started selling your product, you might have the next level of investors, private equity houses. And private equity houses, they raise funds either from angels or from high net worth individuals, so very wealthy individuals, but typically from institutions. So pension funds, for example, might give a private equity company money to invest. That if you've got a pension, you might have that invested with a company that invests in private equity companies. No, private equity companies need to identify a whole range of businesses with different risk portfolios so that they meet a risk portfolio that has a certain return. And that's what a private equity company will do. And they tend to invest in companies that have sales traction. So you need to be selling and you need to be doing well. And what they'll invest in a company for is to grow. And they'll be looking for considerable returns.
So what if
After
someone?
that,
Okay.
there's this term series. Oh, sorry. I
No,
was going
no,
to say,
please,
so
please.
after that, you get into yeah, those terms are sometimes called Series A, Series B, Series C. So you
Yeah.
start with, pre-seed, seed, Series A, Series B, Series C, and the types of investor in those rounds are angels, then VCs, then private equity, or a mixture of all of them. Typically, to do a funding round at any level, you need more than one investor.
Okay, but you mean also more of one type of investor, or you usually, I mean, are very strict, like, or you can have angel and VC overlap?
Yeah, so this is where the terminology issue is that I described at the start. Anybody can invest in anything. Um, Angels are more likely to invest in something risky because if you think back to their alternatives, an angel investor is an individual, their alternative is to get 5% interest by putting it into a bank or buy a car or go on holiday. So in order to be better than getting 5% interest in a bank, they need to invest in something risky, high risk, high return. And therefore they're going to invest in a startup. They're going to say, Terence, I believe you're going to make this clothes company successful, and I want to be in, and I want to get a high return. Um, Whereas private equity companies at the other end of the scale, they're protecting huge numbers of people's money and institutional investors' money, and therefore they need to be very, very certain of the risk profile. They can't necessarily take a risk on something that won't be successful. They need to be taking a risk on something that's going to be either quite successful or very successful. And they determine that really by sales traction and what your business plan is and how quickly you're going to grow, which is why it's more important at a later stage.
It makes sense. Also, I find it very interesting that, as you said, the riskier the business it is, but at the same time, the investor that would invest more likely are those with less technical experience over that, which can be counterintuitive, right? Because you need to have technical skills to understand the risk, but it is more about the
Yeah,
trust. It's more about.
I think it's more about whose money is at risk. So as an angel investor, it's your money at risk. You've earned it. It's yours to do with what you like. If you're a private equity house and you're a fund manager or an investor rather, and you're investing other people's money, and you're not just investing other people's money, you might be investing pension fund money. So the money that the elderly will rely on. The risk profile and the amount of work needs to be incredibly diligent, and therefore the people that do make those investments are highly paid. They're city bankers whose whole role is to make money on those investments, and more importantly, not just to make money, but to hit a very specific risk profile. So they want the very best PE investors are the ones that can hit a percentage return on investment, 5% or 10%, and they can manage that across a portfolio of investments, because there's a very linear relationship between risk and return in financial investments.
That makes that makes sense. That makes sense. And I mean, you as an investor, what usually you look for outside of the idea itself? What capture your eye when you think about something that you want to
Yeah,
invest in?
so it's every investor will tell you something different, I think, but the key is that they need to make a return. They need to make money. The difference between different investors is what criteria they think are required to make that. So some people will look for a very experienced management team or a team that with proven success. Some people will look for an innovative idea. Some people will look for good market fit. I described, a rubbish pen. It can be a rubbish product as long as there's a market for it and people will pay for it. So I think the way that you get to success is different, and investors will look for different criteria. I think in general across all of those types of investors that I talked about, so angels, VCs, and PEs. A founder, a good founder is very important. More important, as important rather, is the exit strategy. So obviously nobody makes any money if there isn't an exit point. So I'll just explain what that is. So if you invest €5,000 in my clothing company, you've given me €5,000. What happens next? Well, I use that money to buy a shop and start selling. You don't get your money back until I sell that business.
Yeah.
And when I sell that business, you'll get some money back. So that's called the exit point. So you might buy 10% of my business for €5,000, and in 5 years it's worth hundreds of millions of pounds, and you get 10% of hundreds of millions of pounds. So happily, Alessio. But there has to be an exit point. So a founder has to have an exit point. Now, in knowledge-intensive industries where the founder might be a very intellectual person who's created, built a great idea. Maybe they're a software developer. That's a great example. Software developer who has a unique skill that no one else can do. Well, really, there's not going to be an exit because the company doesn't exist without that person. So what you're looking for as an investor is you're looking for, a passionate leader in a founder, but somebody that is dispensable. If they're indispensable, the company won't survive without them. So that founder needs to build a management team. They need to build out structures that mean that the company is going to continue in their absence. So that's something important that investors look for. Obviously, sales traction and product market fit. So people need to be able to buy the product. There's lots of great ideas that will never be successful because no one will ever pay money for them. There needs to be a willingness to pay and an ability to pay amongst a market. So I think those three things really. That's what everyone would be looking for at every level. There's nuances to depending on the level, but those three things are critical.
The exit strategy, I think it's a valid point also because in this specific sector we tend to identify a lot with our idea. So I mean, as a if you are a founder and you start your company from an idea you had and you feel like this is your idea and it can be only yours, so then hello,
You're back now.
Yeah. We will cut this out.
Edit it out.
Yeah. Anyway, I mean, we were saying about that. No, that the idea sometimes, no, it's it feels like it's your baby when you are a founder. So it is important that on the other hand, when you are founding your idea, as you said, no.
Yeah, and that's what we call that as exit planning. So you have to have an exit in mind. A theoretical exit, and that could take a number of forms. So either you can IPO, so you can float your company on a stock exchange. That tends to happen with companies that are very mature and very successful after a number of funding rounds. Or there needs to be the next funding round. So if you've done your seed funding round, then your Series A or Series B funding round might buy out those investors. So they might invest you at seed round and then exit at Series B. Or there might be a trade exit. So a company in the same industry might buy you. So trying to think of a good example, maybe, when Red Bull first started, a good trade exit for them would have been being bought by Coca-Cola, who are already an established massive company. So that, but you're right, there has to be some sort of exit for companies.
And what makes the biggest challenges for companies to start up to get funding, and how they usually deal with that, how they overcome that?
Yeah, so biggest challenges. So getting funding is really difficult at any of those levels that we've talked about. So the first is how do you find your target customer? Because what you're doing is you're selling an idea and you're selling an investment. So if you think about any company trying to sell any product or service, it's difficult to reach that market. And in the investment market, there isn't a shop. There isn't a marketplace where you can just go to and trade your idea or something like that. So you have to find potential investors. That's easier. It's almost a bell curve. Or an inverse bell curve. It's easier at angel level. It's easy for friends and family. Obviously, you know who your friends and family are. You know who you can go and ask. Convincing them might be different, but you know who they are. With angels, it's similar as well, because anybody who's an angel investor will probably actively be looking. And there's loads of companies, and some are successful and some are not. When you get to VC level, it becomes incredibly difficult. Firstly, there's relatively few VCs, and it's difficult for VCs that are not established to raise funds. They've got to get people to believe that they're going to invest their money well. But then VCs see hundreds and hundreds of pitches. I think I spoke to one the other day. I think they see 800 pitched a year, and they're ones that have been already vetted. So 800 good pitches, and they invest in 10. So you've got kind of a 1% chance of getting VC funding. So you've really got to differentiate yourself as well. Sorry, we'll come back onto that. So finding them is difficult. Then when you get to PE level again, it becomes more straightforward to find them because they're well known. They're well known companies, and anyone can find them by googling them. They're big houses. There's databases of them. So finding the investor can be tricky. Then differentiating yourself is also particularly difficult. The best way to get an intro to a potential investor is a warm introduction. So you've gone to a network, either you know somebody who knows somebody, or you go to a networking event. There's a lot of bad ways of doing it as well. So pitch competitions, in my experience, is one bad way. So some people set up pitch competitions and invite people to come and pitch to them, almost like the dragon, like a Dragon's Den type thing, and they can't really offer the investment to the people that are pitching that they say that they can. What they're trying to do is harvest and either take those ideas and utilize them themselves, or they're going to farm them out to other companies that can do those ideas. So you have to be quite careful as well with who you're approaching. So number one, so going back to the original question, what makes it difficult? Finding the right type of investor, actually being introduced to them and taking it seriously. Once you've got past that, what you'll typically be asked to do is pitch. Most people can either pitch their idea themselves, or if they've got to that stage, they've got the commercial or business acumen to be able to either find support that can help them to do it properly, or they can teach themselves how to do it properly, and they'll come up with a pitch deck of 10 slides that go through the problem that they're trying to solve, the solution they're trying to, a business case that shows sales and profit up, and that kind of thing. If a company is genuinely interested in, or an individual is interested in investing in that, then they'll go through a due diligence stage. So that's where they'll really dive into what you're doing. They'll do commercial due diligence. So they'll try to independently understand your market. Is there actually a market for your product or service? And they'll get some technical people to do technical due diligence and look at your product or service and say, does it actually do what they say?
Okay, so we were saying like there is a sort of a inverse Gaussian curve, right? When you have the angel investor was quite easy to find because they are actively looking for something. Then there is a sort of a pit of despair where you have to find the VC, and then it gets better. But why the VC are a little bit more, challenging to find?
I think it's because it's the risk point. So angels clearly want a very specific type of investment. They want something that's going to be better than putting their money in a savings account, or something that's going to be substantially better that will generate wealth for them as an individual. So they're happy to have risky investments. PE houses need to know that they're going to make a very certain return. So that's quite easy to compartmentalize. VCs, they play on that area where they're trying to take a risk, but they need to be certain. So, conversely, they need to find a company where they can be 90% sure that somebody is going to buy the product without any evidence that they're going to buy the product. And therefore, the convincing of them is, infinitely more difficult, unless you can generate sales. The good challenge to have for a company is that if you can generate sales, then you're probably going to make a profit, and therefore you probably don't need VC investment, or you don't need it as much, or you only need it to accelerate, but it's not a requirement. It's something that will help rather than the lifeblood of the company.
Yeah, exactly. No, I mean, once you start getting sales traction, probably you will have enough funding yourself. The benefit for investors that sometimes the government puts together, and how they can help someone convincing you to enter in this stage.
Yeah, so are you talking about sort of SEIS and EIS investment? Yeah, so SEIS and EIS are UK specific, but there are other countries that have similar schemes. So the UK government started the I'll call it SEIS, but it's the Seed Enterprise Investment Scheme, or the Enterprise Investment Scheme, and the UK government created them to generate more investment for companies that would contribute to innovation in the UK. So the SEIS scheme is an absolutely incredible scheme. It gives 50% income tax relief to people that make an investment. So if you're a founder, you can get your company SEIS assured. It's called advanced assurance, but basically registered for SEIS. What that means is that anyone that invests in your company up to £250,000, I think the limit is at the moment, they'll get 50% of their investment back when they do an income tax return. So if someone invests £50,000, they'll get £25,000 back from the government. Then if the company goes into liquidation, so if it fails, they'll get another 30% back. And all of the benefit of the investment isn't subject to capital gains tax. So you get capital gains tax relief. So what that means from an investor's point of view, so if you're a UK national investing in a UK company that's registered for SEIS, is your investment is almost risk-free. Which means that investing at those angel rounds,
they do this to help also like this sort of process, because you will have a sort of an insurance from the government, right? That even if the company doesn't go well, you are protected.
Exactly. So you get the 50% back straight away. You get 30% back if the company goes bust. Beyond that, the UK government actually do government-backed grant loans as well. So the government growth scheme effectively means that companies can get loans without any security. So typically, if you wanted to get a personal loan from a bank, you would need to secure that against something, like your house, for example. As a founder, you're not going to necessarily put the house of your family on the line as security for a loan. But government-backed growth scheme in the UK effectively acts as the security for that.
Okay. But is this is the company that needs to apply for this and then show this to the investor, or how does it work?
Yeah, so the company applies for SEIS via HMRC. The process takes a couple of months. There are criteria. So the company needs to be less than 7 years old, or not have traded for 7 years. It needs to be of a small size. So then there's maximum balance sheet and asset values for startups. I think there's a maximum number of employees as well. So it is very focused on startup companies and small companies. But anyone can apply for it. I think the success rate of application is really good. It's not really an application process. It's if you meet the criteria, then you are eligible. And like I said, for investors, it almost completely de-risks the investment. And then if you think from a founder's point of view, that makes getting angel investment easier, for one. But there is still the risk of failure, because even if your investors give you money enough to try and make your business successful, you're still, you're still investing personal time and effort, and probably some of your own funds. So a founder can't take advantage of SEIS, for example, nor can their family. So it's just for investors.
Yeah. No, that's interesting, because again, coming from a scientific background, many people might not even know the existence of these tools that could help them attract more investors.
Yeah.
So I was saying, like, with this tool, do you feel like, I mean, does the startup market has changed thanks to this? They retain more investment. Does it have an impact? An actual impact?
Yeah, it's interesting. I think it certainly has an impact from the angel investor point of view. So I certainly, as an individual, wouldn't invest in non-UK companies that weren't eligible for SEIS. So in terms of, in a global world, I can see pitch decks from a number of different countries, a number of different startups. The fact that I'm based in the UK as an angel investor means that if there's a UK company that's SEIS eligible, it's instantly going to be worth 50% plus 30% risk alleviation more to me than any other investment. So I think what it does is it secures investment for UK companies, certainly, over other companies, or non-European, non-UK companies, which is quite a protectionist intent, which I think was the intent. I don't think it necessarily means that people are likely to invest more. And it certainly is not widely publicized. I didn't know anything about SEIS until I started angel investing. If I'd known about it before, I probably would have started investing in companies
even
more.
before.
And I imagine if it was more widely publicized, a lot more people would. Because there'll be a whole range of people, depending on what's happening with interest rates, what's happening in the global economy, who would look for higher return opportunities than just putting their money in a bank or something like that. But with the sort of guaranteed risk prevention. So if you think about a sort of let's say a person with a young family who therefore can't waste money, but is professional, has a good career, earning a good salary, their opportunity to make more of their savings or their wealth at the moment, they could put it in crypto.
Yeah.
They could gamble with it. But the SEIS scheme means that they can take sensible gambles that are effectively, risk mitigated to an extent. And that's a really attractive proposition for people. I don't think it is publicized enough. And actually in local regional UK schemes, typically government benefits for founders tend to center on training. We can help you put a business case together, or we can help you understand what a P&L or a balance sheet is from a finance point of view. But they don't focus too much on funding, and funding is really what is typically the difference between a successful company and a very successful company. Because funding can help you accelerate doing whatever you're doing, be there before your competition, get an idea to market, and so on.
Yeah, and from the investor perspective, like, how much weight also in terms of decision and also like impact on the company you usually have. So like sometimes when you I mean, you invest in a company, you buy shares of the company,
Yeah.
but do you sit on a board? How much drive you have on the company?
Yeah, it's completely variable. So think about it from both perspectives. So think about it from a founder's perspective. There'll be a range for a founder of how involved they want investors to be. They might want support. They might want networks and connections. They might want help doing something, or they might not at all. And that again changes as you go through the different rounds. So an angel investor typically, is going to be an individual who happens to have some money. They're probably not going to be able to offer a lot of help. Whereas a PE house might have other companies in its portfolio that are able to partner with you. They might actually have customers in their portfolio. They might be able to give you sales expertise. Because everyone wants to help the company. There's no enemies. Once they're invested, they want it to grow. So from a founder's point of view, there's a lot of opportunity out there, and it's really important that founders take on investment that suits their need. If they want help in a certain area, then they should find investors that can help in that area, because the investor's incentivized to help the company. Obviously, otherwise they don't get return. Nobody wants to see the company fail. So that's from the founder's point of view. From an investor point of view, it differs by level. So everyone wants to protect their investment. They want the investment. They want the company to be successful. So if they can help, they will. But equally, depending on the legals of the transaction, you can determine as a founder how involved they are or not. Some companies will want a seat on the board of the company because they want to protect their investment. They want to steer it. They want to be part of a governance or a steering committee. But as you go from PE through VC back down to angel investment, sometimes you can pick up angel investors that have a specific skill and something that you really need. Or an angel investor might have invested in the company because they share the same passion. So, if we talked about med tech founders being, or healthcare founders rather, being, particularly passionate, you might find someone that shares that passion, and they might want to be really involved in the company. You might want that, or you might not want that. So it's a complete variable. It's completely variable from the founder point of view, and it's completely variable from the investor point of view. But what's important is that they don't conflict. If there's ever a conflict, that can be really damaging for a company. If you've got an investor that's too overbearing, or a company that's floundering because it's not getting the right levels of support, they're typically, other than board positions or predetermined support requirements, there's no legal obligation for a company to take advice from an investor, nor for an investor to give advice. So it needs to be really hammered out and contracted at the stage at which someone's investing.
Also because, as you said before, the number of investors might vary, and one might not be enough. So you might have to deal with a lot of heads in the room, and everyone might have his own vision and his own opinion about what the company should look like, should do. So it's important that everything is, contractualized and
I think
clarified
just on
before you
that.
start.
Yeah, on that point, Alessio, there's different share structures as well. So, and there's different types of shares. There's shares with voting rights. At the end of the day, investors aren't going to have an operational input into the company. They might have a slight strategic input, very slight, but the founder will almost certainly own more than half the company. They'll have a majority share, and they'll run the company. I think it's quite rare that investors fall out with founders up until the point of potential exits, because what has been agreed or commonly understood, an investor might invest in a company and think, well, we're going to do a trade sale in 5 years. When the company's grown, we're going to sell to a big competitor, and at that point, the the founder might have been enjoying the luxury lifestyle that they've built up, the lifestyle business. They might enjoy the fact that they're the figurehead of a company. They've attained some fame and so on, and their opinion might change. The investor's opinion rarely changes because they're constrained by their investment thesis and the risk profile they're trying to attain. But a founder changes over that period. And even if you think about just personal growth, when you start a company to running a company that's 5 years old and successful, the job has changed, the reward has changed. You've gone from generating ideas and trying to make something work to managing 100 people, and your job has changed, and your outlook on life has changed, and things change for the individual. And that's where, when it comes to exit, that's where founders and investors can sometimes fall out.
Yeah, that's a good point. Yeah, I mean, you can see the difference now between a startup environment at the beginning that you just have, ideas and focus about the technical aspects, how to make your idea works, and then after that is about managing a structure. Yes. Everyone has a defined role. I mean, we can see. I mean, we work together in IDM how the company has been like fluid in terms of roles, and people are doing like a little bit of everything. But in the future, I mean, with the strategy that we are starting, it will be more structured and more.
Yeah, and I think, Alessio, towards the start of our conversation, I talked about a founder being dispensable. A founder, someone who the skill set to come up with an idea, to be passionate about it, and to make it work is very different to the person who can be the CEO of a company, or the managing director of a company. They're completely different skill sets. And I think it's actually probably quite rare that a founder becomes the successful CEO of a company. Either they'll exit, or there'll be some sort of event that happens. I think the ones publicly known unicorns tend to be quite high profile, where you've got like a Mark Zuckerberg or a Bezos or something, where a founder has done that, but they've reached that level because they've got both skill sets. 99 times out of 100, the founder doesn't have the skill set to run the company, and if they're dispensable, then that's great, because they can make a lot of money from that. They've come up with an idea, they've started a company, and at the appropriate point, that's appropriate from both points of view, they exit the company, and somebody who can run a company and run a continuing company takes over with the correct skill set, and everyone wins from that. But I do think the skill sets are particularly different.
Exactly. How different they are? What are the, let's say, more important skill set that the founder has, and the one that a CEO or like a managing director must have?
It's a great question. So I don't want to call founders disorganized, but the person that's running a company needs to they need to be empathetic. They need to know how to manage staff. They need to know how to delegate, importantly, because they're not going to be doing the things that they want to do. And importantly, they're not going to be doing the things they enjoy. They're only going to be doing managing of other people doing activity. Whereas when you're a founder, you're we talked a lot about passion at the start. They're passionate about something. They're probably doing it. They're building it. They're involved in the technical detail of it. And importantly, I think you used the term, it's theirs. It's their baby, and they're protective of it. Going from that to giving it away and letting other people work on it, people that won't do it in the way you want it to be done, people that have different ideas, that you wanted your product to be red, but everyone else thinks it should be blue, and now the person that makes the decision on the color isn't you anymore, it's your director of color. It's a completely different skill set. And I think there are successful people that transition from one to the other, but I think in order to be successful as a founder, you need to be protective of it and driving things. I don't think ideas aren't really generated by teams. They're generated by individuals, and an individual has the passion and drive to do something and then builds a good team around them. Whereas when you're at a later stage, a company requires good management and good processes and regulation and governance, and those are probably not just different skill sets, but they're probably different personality traits as well.
Yeah, that makes sense. Absolutely, absolutely. And giving, like, now you have been in this field for a few years, like, how do you see like the startup world and the startup in specific in the med tech or healthcare sectors going, and how it has been in the last 5 years, and how it is, in your opinion, going to be in the next 5 or 10 years?
Yeah, I think so. I think if I'll cover medtech first, and then the startup world. So, I mean, they're both changing for the same reason, and that's AI technology. I think in the medical profession, there's accelerating research. There's automation. There's accelerating medical innovation because of AI. I think in terms of the industry, there's almost a decent. It depends on territory. There's a decentralization of healthcare. I think we talked about before the fact that NHS England is being dissolved in the UK. That makes a substantial difference to what happens in the NHS. But equally, the population of the world is aging. The population of the world is growing, and people are less tolerant of poor healthcare. And that means for the medical community, there's a huge amount of demand and a huge burden. So I think in the next 5, 10, 20 years, there'll be a huge amount of institutional investment in healthcare. There has to be, there's going to be, a population over the age of 60 that requires the level of healthcare that they've been used to in our modern society and world at the moment. And that's a huge burden, and therefore processes need to improve, things need to be more efficient, they need to be quicker, and they will be. So in the medical world, improved efficiency of healthcare, and particularly the point of care as well. So moving healthcare from hospitals into communities and closer to the patient, I think is a massive trend. So that's from the medtech point of view. I think in terms of fundraising, risk profiles change because of what's happening in the global economy. So investing in startups is highly linked to your other investment opportunities. So if interest rates are high, people are more likely to put their money in a bank, and if they're low, they're more likely to invest in something else. People's perception of job security and job stability. So if the global economy is affected by the war in Ukraine or Donald Trump as a president, and there's instability, then people are less likely to invest in risky investments and more likely to invest in low risk investments. So there's a change in investment risk profile. But for startups specifically, the speed of idea generation in the last couple of years has massively increased. I think in the next 5 years, there's going to be 10 or 100 times more startups than there are at the moment, because anybody can start a company. Anybody can use an AI tool or a chat GPT or anything to do research, product market fit, to develop pitch decks, to get to the point where they've got a valid idea. They can do idea validation. The speed of being able to do those things is so much quicker with the technology we have available at the moment. And that's just going to increase competition for funding specifically. But the level of funding isn't going to change. It's going to be there or thereabouts the same, depending on what's going on in the global economy. It's going to be about the same. So you're going to have a lot more founders competing for the same amount of investment, and I don't know how those founders are going to differentiate themselves. I think particularly as the tools used are consolidating as well. So if you're a founder at the moment, a typical, I know this because I've done it a number of times, a typical route would be you do some research on you come up with an idea, you do some research on ChatGPT, you build a website in Wix or GoDaddy. It costs next to nothing, and they all look the same. You create social media pages on Facebook and Instagram and LinkedIn, and you've almost got like an identikit ready company within the space of a day. And because the barrier to entry of doing that is now so low because the tools available, and because the tools are very similar, they all congregate amongst the mean, and you get a lot of companies that look the same, feel the same, doing the same thing, but with not a lot of substance behind. So there's going to have to be, I think, in the next, in a few years, there's going to have to be a transformational shift in how funders, how VCs and PE companies and angels cut through the identikit company to find what's a genuine idea. And equally for founders, that the way that they differentiate themselves is going to be completely different. I think maybe it will be a case of people will go back to a lot more sort of in-person physical networking and warm introduction, and that will be the way that people overcome that. It's going to be interesting to see. There's only so good that a good-looking visual pitch deck is more likely to get investment than one that's a bit rubbish. But because everybody has the same tools now and can make their pitch decks look good, there's little to differentiate on visuals. There's little to differentiate on sort of financials. There's people can build up social media profiles pretty quickly. So but this is a good thing, that the more startups there are for it might not be great for founders who are competing with other founders, but for the world, the more innovative ideas and the more chance or the higher chance that there are for people to bring good ideas forward, which there is more of now, is great for development and innovation. I think there'll just be more people trying and more people disappointed.
For a founder, exactly. That would mean putting even more effort in developing your idea and making sure that, also because sometimes all you have is a 10-slide deck that you send across to a number of angel investors. Hopefully it will open. So they just look through it, and the message needs to be loud and clear about what you want to do, what's your idea about. And you're right. Using the same tool, you might end up having the same results. And with the hype on AI as well, everyone wants to put their label on, and then every slide deck that you receive will look like an AI company. That's it.
Exactly. Yeah. And I think but going back to one of the points I made earlier about sales traction and peer validity, if you can get to those, if you can get to sales traction, then you're instantly setting yourself apart. So I think maybe there'll be this, I'm thinking off the top of my head now, but maybe there'll be more of a trend towards bootstrapping, towards companies trying to fund it themselves using friends and family rounds, and trying to build a product and getting it much further down the journey before they go and seek further funding. It's probably a likely outcome, actually.
Yeah. Okay. Well, that makes sense. And from the politics perspective, do you see more investment or more interest in the startup? We talk about the government tools like say yes, but also like any other, or like, do you feel like it's going to be more or less in the UK or global, whatever?
I think the number of ideas will continue to increase because of the speed of innovation and the research people can do. But I think the number of routes to getting funding will consolidate. So there's a lot more companies operating, I think, particularly in healthcare, in the process and workflow improvement space. So whereas before you might think, I've got a great idea that can improve a patient outcome in a very specific, narrow area. Now there's a lot of companies who see it as their role to improve processes across a whole swathe of healthcare. So I think that's different. I think, is there going to be, what was the question? Is there going to be more investment for companies like that?
Or more like interest from the government in fostering, like, in pushing investors, like, I don't know,
Yeah, I
the
think
tool that we discussed or other, I don't know.
it's interesting because without getting into deep politics, Alessio, the in depending on which country you're in most countries, we have a two-party system, don't we? In most countries, we've got Republicans and Democrats in the US, we've got Labour and Conservatives in the UK, or maybe Reform, but we tend to have two-party. We have party politics, and party politics lends itself to short-term policy making, to winning an election. We're going to do this in the short term. We're going to benefit the public in the next 3 or 4 years, and there's a short-term thing there. Investing in innovative companies and trying to develop an entrepreneurial base of individuals in a company is a long-term policy. So when it comes to the choice that a company might make, if there's global instability, or if a country's has to make choices between increasing its defense spending, which is topical in Europe at the moment, or increasing its investment in small companies. At the moment, they're going to pick the short-term option. They're going to pick the option that's right for the country at the time. So I think at the moment, while I've got a level of instability in the world, we're probably not going to see much more government or institutional investment in building an economy from the ground up. We're probably going to see it in short-term measures like tariffs, for example, or things that can benefit a country in much more mature industries than startups, which is a shame, because it's a short-term view. But at the end of the day, every company has started with an entrepreneurial idea, and they've either, some of them have survived or accelerated because they've had specific government support, and some have been successful in spite of that.
Yeah, I mean, that's a really valid point. Yeah, exactly. And how things has been changed during the history, right? I mean, and even how innovation can change during this due to factors you might think are not related at all, like politics or war, or like in general instability. Because sometimes, like, if you are in a situation where there is, as you say, the global instability, you might have a great idea, but you don't feel like safe to leave your job to start your own company.
Exactly.
So probably the idea will stay in a drawer for the rest of your life. And that is a shame, but that's because the history of the world is changing.
Yeah, I think just on that, I think what we do have now, though, is the tools and the ability that are publicly available to anyone to try an idea and test it. You don't need to leave your job necessarily to do certain things now. And with the rise, certainly in Western economies, of things like remote working, fast internet connections, ChatGPT, AI tools, graphic tools like Canva, no code tools to develop like software development. There hasn't been a better time ever to be an entrepreneur, to start that. There's more competition, but the risk is much less. You don't need to leave your job to start a company now. In most cases, in most sort of service software type companies.
Yeah. So what advice would you give to entrepreneurs, or like wanna-be entrepreneurs now, about, like, if they have an idea how to start, what to do, what would you advise?
Yeah, I think number one, absolutely, you've got to have product market fit. So no matter what your idea is, whether it a physical product, a service, you need to know that people are going to buy it, and you need to get in front of potential customers. You need to get feedback from them, listen to them, understand their ability to pay, their willingness to pay, what's the price point going to be. And you need to really treat it as a commercial enterprise, because if you've got a great idea that will help humanity, if no one will help you, if no one will invest in you and no one help it grow, then it's not an idea at all, and it will flounder and stop. So even if you don't want to, even if your ethical being says this is a humanitarian charitable type enterprise, you still need money to find it. That's the capitalist world that we live in. So you really need to focus on how you can monetize it and commercialize it, because without that you have nothing, and the idea won't grow. So the first thing is getting to it's called product market fit as quickly as possible, a product that's going to fit in a market that people want to buy. So every time you have an idea, don't focus on how good the product can be, how many features it can have, how many different functions. Even if you think it would be great if it did this, I'll develop this, I'll do that, I can make it amazing. It doesn't matter unless someone's going to buy it. I mean, I think try to think of a good example, but a pen, at the end of the day, someone's going to buy a pen because it writes. Ideally there's lots of ink in it, so I don't have to buy another one. It doesn't crumble and fall apart. There's hygiene factors, but if you're going to make it out of gold, if I was designing a pen, it wouldn't be this pen. It would be, it'd have a TV remote in it or something. There'll be other features and functions. They're only relevant to me as a founder. It needs to be something that the customer is going to want and the customer's going to buy. And so that's number one. I think in terms of we've discussed funding a lot, getting to sales traction as quickly as possible without funding is really important. So bootstrapping, trying to sell the first core version of your product to anyone, such that you can use that money to improve the product, and getting sales traction, because that not only does that mean that you need less funding, but it proves that people will buy the product. And then when you get to the point of needing funding, you've got a whole evidence base of customers, customer feedback, lessons learned, and so on. So that's second. I think third and final is the fail fast principle. As I said, we're in a world at the moment where it's easy to try. It's easy to start a company, and if you don't try and don't start, it will never happen. So start now. There's a book by I think it's by Rob Moore called I think it's Start Now, Get Better Later, something like that. But it's the right principle. You don't need to be perfect to start. You just need to start, take that first step on the journey. And there's lots of people out there that can help you.
We have a way of saying in Italy that sounds like done is better than perfect.
Yes, exactly. That's exactly it. Yeah. And the thing is, by doing the first bit, might not be perfect, but you'll learn a lot of lessons, and at least you'll know whether it would work or not. Yeah. And if it does work, you scale it, and if it doesn't work, you change it, and then it does work, and then you scale it. So there's no such thing as a bad idea. So
it is a process. No, it is a learning process, and you might start with your idea and realize that it doesn't work, but it doesn't need to, you have to trash everything away. You can just slightly change your direction. You might end up in the gold zone of having your product fit for market. So absolutely, but you will never know unless you try. So that's definitely a valid suggestion. I mean, Terence, I think we talk about a lot of things, very interesting, and I'm sure that the people that listen to us that are mostly like scientific mind would benefit from this, because as I told you, we scientists don't have this kind of skill set. We don't have this kind of knowledge, and we are not equipped with this kind of knowledge, but we usually are the one with this innovative idea and the skill set to build these kind of tools. So it's important that we publicly talk about this, that people get exposed to these topics, so that we can also foster the innovation, foster the entrepreneurship that it might be in any one of us. So Terence, thank you very much for being here with us today, for participating, for the very amazing talk, and thank you everyone for listening. Speak soon, and bye-bye.
Cheers, bye now.
That's a load of science.